We welcome today Michael Heise to AICGS. He's the chief economist of Allianz, the biggest German insurer, one of the biggest worldwide. And Michael Heise has just recently written a book about the euro crisis, emerging from the euro debt crisis. It's a hopeful look into the situation as we find it today. It's also a hopeful look into the future, which the crowd in Washington sometimes is not used to hear when talking to German economists who have a sometimes rather gloomy outlook on the situation in Europe. We have some recent data coming out of the Eurozone indicating that the situation might at least stabilize. Where are we? What do you think?
Well, the short-term development is positive, I think. We have seen that the Euro economy has moved out of this very long and very strong recession, which lasted 1.5 years in the second quarter of this year. We think that also the third quarter will be yield a positive number. The big north-south divide we had in growth in Europe will slowly become smaller. With some recovery of the economy, the tide will come in and lift all of the boats. So even the countries, Italy, Spain, Greece, Portugal had a very good second quarter, will slowly recover. And this is the short-term outlook, which has to do a lot with an improvement in the financial conditions in Europe. Following the famous Draghi speech, markets have had an impressive rebound. But they also have to do with the fact that major adjustments have taken place in many of the economies. This is sometimes not emphasized enough. Unit wage costs have been going down. Current account balance imbalances
Across all these countries?
Across most of these countries, yes, have been eliminated, basically. The current accounts are back in balance for countries like basically Greece, Italy, Spain, Portugal. This has a lot to do with the recession, of course, and with the decline of imports, but it's also a sign that the competitiveness of the economies is recovering. These are some of the main reasons why we were expecting a bottoming out of the economy this year, and it is happening.
Bottoming out is, of course, different from resumption of robust growth. So if we look into 2014, and given the picture that you just described, are there any elements for not only a stabilization of the situation, but a resumption of growth that can also make a dent into this very high unemployment numbers that we have across part of the Eurozone?
Well, I think we will have growth in the year 2014. The factors I mentioned concerning financial conditions, concerning the adjustments of competitiveness, they will be accompanied by an impact of the structural reforms that have taken place. Of course, there could have been more reform and quicker reform, and many people have criticized the pace of reform, but quite a lot has actually also happened, and that will show some impact in 2014. We think we a little bit take some guidance from the German reform attempts in the years from 2002 to 2005, which were quite thorough and which had a quite strong and not very strongly lagged impact on the employment, on growth in the German economy. And similar things we think will also take place in other European economies.
Now, looking at the civil situation in Europe now and looking at the next few weeks, we of course have September 22nd looming large, the German elections, and a lot of Europeans are looking at Berlin for signs after September 22nd that maybe the euro crisis management could see a shift, or at least a slight modification. What do you expect from Berlin after September 22nd? And are those hopes in the periphery of Europe when it comes to the usual debate of austerity versus growth? Are they grounded into something more than just hope that Merkel or whoever will be in charge after September 22nd might change its tack in this crisis?
I don't think that these hopes are really well grounded. I don't think there will be change of strategy. There might be more acceptance of specific and very targeted measures for countries like Greece, for example, where some prolongation of loans or maybe some interest reduction may be in the cards, and I don't think the German government will stand against that. But I see whatsoever no change in the strategy that has been applied in crisis management, and I think it wouldn't be sensible to change the strategy. The strategy has been to buy time via rescue funds, via ECB interventions, and to ask in exchange for the support for countries in problems, reforms. And basically, despite many errors that were made in the process, basically this is the right strategy, and it is gradually bearing fruit. So I do not see a major change in this stance.
Before we look across Europe, or outside of Europe rather, let's take a look at some of the countries that have been affected or could be affected by the crisis. First of all, you mentioned Greece, of course. They, I think, are much closer to a primary budget surplus now, which of course would make it easier after September 22nd to renegotiate some terms, some bailout terms with the creditor countries. But the big elephants in the room are probably Spain, Italy, and some say France. What do you think?
Well, for all these countries, the dipped situation is of course of concern, but it is manageable. You can do many simulations with different assumptions, and if you just assume that moderate growth resumes in these countries, growth of around 1.5% in real terms and maybe somewhere close to 3% in nominal terms, and if you also assume that these countries will come up to their commitments they gave to the EU Commission in terms of slowly reducing their budget deficits, getting back into a balanced budget position. Under these two assumptions, and assuming that interest rates, which are actually going down, will not hike again, then all these countries can return to a sustainable fiscal situation in the period that has been envisaged by the IMF and the Troika for the program countries until 2020 or 2022. So it is possible, but it requires that these countries stick to their consolidation plans. And it is, I think, very dangerous to insinuate that the consolidation may actually lead into a negative spiral. If countries are cut off capital markets, and if they are in a situation of over-indebtedness, which some are, then consolidation is really no issue of policy optimization, it's a necessity. And I think these countries will come up to their commitments. So there are big elephants, as you say, but the problems are manageable with the right policy.
Now, you, of course, as the chief economist of the Allianz, you're not only looking at Europe, you're looking across the globe. And I wonder, what do you think of all this late obsession with the taper talk? You know, the Fed withdrawing its program, its bond buying program, or at least tapering off the bond buying program, all the turmoil that we are seeing in some of the emerging markets, and a sort of repatriation of capital from emerging markets to advanced economies. If that trend continues, do you think that's going to have an impact on the economies of the advanced economies as well, like Europe and the US? And what impact would it have?
Well, it's an interdependent system, the whole world economy. So this presently negative impact on the emerging markets will bounce back in a way into the industrialized world as well. Although I do think that the reaction of the financial markets to the tapering with respect to emerging market capital outflows is an exaggeration. The situation in emerging markets has not deteriorated the way their currencies have been deteriorating or interest rates have been going up there. I think this is just we've become used to it, the impact of a risk-off mode on capital markets, then capital flows out of these economies, the tide just goes out as it went in the years before. That hits these economies, but it's a temporary phenomenon. Once the exchange rates have fallen and the competitiveness is improved by that way, and then things start to normalize again, and So I don't see a new negative trend for emerging markets for a long time.
So do you think that this is in some way also a reflection of the fact that there is a bit more confidence in other areas of the world economy, advanced economies in particular, the US, which is showing some more robust growth, and even Europe, where the situation, as you describe, has stabilized, and some of these capital flows triggered by the Fed, at least indirectly, are now sort of flowing back to these economies, and in a way, it's a healthy thing?
That's the way it looks, and it is a healthy thing that the industrial economies, which have been badly lagging behind the emerging market world in recent years, are now again contributing somewhat to global growth. This is very important so that the emerging markets don't run into imbalances, to excessive credit, excessive import, excessive current account deficit situations, as some have in the period of strong growth. So now it's time for a change in the motor of the world economy. This is taking place partly as a result of the Fed announcements, but I think this is the healthy part of it. The less healthy part is, of course, how to get out of this extremely expansionary monetary policy. I'm not very much surprised at the fact that interest rates are going up quickly and dramatically after the announcements by the Fed. It is a little bit hard to understand, actually, seen from far away, that these enormous bond buying programs on government bond markets, on real estate, mortgage markets, that they were enforced in a time when interest rates were really very, very low. The question appeared, why does the Fed need these big programs it didn't have to fight rising interest rates. Now it does.
Yes.
And now a move out of these programs is, of course, can be quite painful for markets that are already going up in expectation of some future moves. So it's a very difficult situation to redo outright purchases of assets, of government paper. The ECB is in a little bit of a different situation because it has repo agreements, partly long-term repo agreements, but they run out at some point in time, and it doesn't have to sell into falling markets.
Yeah, well, the ECB hasn't bought assets. It has in the past bought some government bonds, but that's part of an old program. The new outright monetary transaction program of the ECB has never been activated. The Fed has actively bought assets, not only government bonds, but as you mentioned, mortgage-backed securities, for instance. But haven't they done so because the truth is that even in the US, fiscal policies have been now for some years quite contractionary, and therefore the central bank saw itself almost forced to sort of counterbalance, to offset that contractionary fiscal policies by adding stimulus to the economy and get it going again?
Well, that was the motivation, certainly. I doubt how strong this expansionary impact would have been in a period where you had long-term interest rates below 2% in any case, even before the big buying programs were announced. I don't know if there was a big liquidity shortage in the banking system that was healed by these asset purchases. Of course, in the end, the net effect will have been positive for the business activity, but I don't think it would have been a very strong impact. So I think now the situation, fortunately, is changing, that the fiscal consolidation is moving ahead quickly in the United States. That has been, faster than expected.
Yes.
And I think this is a very positive situation, that the negative impact from that side is getting smaller.
So, where do you see the U.S. economy, moving forward in the next few months? There's already talk of a possible new fiscal cliff, or rising the debt ceiling, and there is an expectation that ultimately politicians will do, at least for the time being, what is needed. Do you see any of those dangers looming at the horizon, or do you feel pretty confident that the next few months can be overcome in Washington without causing any damage to the real economy?
Well, last year there was, of course, this very harmful discussion concerning the debt ceiling, concerning this sequester that eventually was put into force. That was harmful because the confidence in the economy and amongst the consumers was badly hit by that. I would not expect such a harmful discussion to reappear. Certainly, there will be again discussions about the debt ceiling, about fiscal adjustments, but I think they can be solved in the mean term. Many U.S. economists say the real challenge is in the long term when the healthcare costs really explode. That hasn't been addressed yet. I would personally agree to that, but I think this year the pressure is somewhat out. There will be
some agreement.
Some agreement. There will be discussions and some
kicking the can down the road.
Kicking it down the road. But I think on the fiscal side, the development has been more positive than one could have expected last year. We have to admit that, and that's very positive because the fiscal break was, of course, one thing holding back the U.S. economy. Was basically the biggest argument why many people said there will be mediocre growth in the U.S. because fiscal adjustment is not proceeding.
Some of the big challenges, of course, at the European level are what is going to take place in terms of more integration. What kind of Europe does Germany want? And it's not just a political question, it's also an economic question. It's what kind of financial markets will we have in Europe? Will we have a banking union? And what kind of banking union will emerge after the current negotiations that Germany, of course, is involved in? What is necessary, do you think? And what would ultimately happen?
Well, I think this is a very crucial and essential question. What is the target picture for the Eurozone in the framework of the EU in 10 years' time or so? What I envisage is further integration. Europe has been and is on the process of integration. It's an evolutionary process. It's sometimes 2 steps forward, 1 back. It is sometimes painful, and it always takes long amongst either 17 or 28 member countries. But Europe is on this track. It's often disputed that this is true, but if you look at the recent years, a lot has happened in terms of integration. We have new institutions like the EU President. We have countries writing into their constitutions fiscal rules that are supposed to safeguard the rules of the monetary union. We are now in the process of getting a banking union, which you mentioned, which I think is a very important step forward for integrating financial markets. Personally, I would like to see a little faster and more decisive progress with this banking union. A banking union should not be a hidden transfer union where payments go from one country to the other. What we need is a supervisory authority that really is consistent and is decisive and applies the same rules for all the countries. We saw in the run-up to the crisis that banking supervision, which was very scattered in Europe, is actually one of the main reasons why things were not detected and were not countered at an early point in time. So I think the case for a European bank supervisor is very, very clear.
But a strong banking supervision can only take place if there's also a resolution authority in case a bank needs to be wound up, and also a resolution fund in case to cushion some of the losses that creditors of that bank might incur into. And this is where it seems Germany is putting a lot of pressure on the brake pedal rather than on the gas pedal, because especially when it comes to resolution authority and resolution fund, Germany is skeptical.
I think your observation is very correct. Germany is pushing the brake on the issue of funds to back banking restructurings. I personally, of course, the motivation is a political motivation. It is hard to explain to the German electorate that besides paying or guaranteeing for the funding of governments, now also banks that have misspeculated or run into problems in other countries will be funded by the German and other taxpayers in Europe. This is a politically not very popular view. But I think that these excessive, how would you say, transfer schemes can be prevented, and they should be prevented. So Germany should not be pushing the brake too much. We have the situation that a banking supervisory authority in Europe can refer to the funds of the ESM, the European Stabilization Mechanism, in a certain magnitude, and use these funds to recapitalize a bank if it thinks the bank is not insolvent. It's illiquid but not insolvent. It can recapitalize. Otherwise, it would have to be wound down. So there are already some means which can be used for this banking supervision, and in the long run, and I think that will also be palatable in German politics, the banks themselves will start to accumulate a resolution fund that can be used for default cases.
Which is basically the scheme that we have in the US with the FDIC, and which is basically funded by a levy on banks. But of course, for financial markets, there's always the idea that if push comes to shove, there would always be a fiscal backstop if things deteriorate drastically. And even such a resolution fund cannot have all the firepower necessary to basically offset disruptive developments in the financial sector and in certain banks. How do you see it?
That's a good point. The backstop mechanism has not been discussed, has not been decided. The present situation in Europe is that it would be the national governments that eventually have to come up for the funds to protect and to stabilize their banking systems, because the means that have been provided by the ESM are obviously not sufficient. It's about somewhere around 50 billion that are still available for these issues. That is not sufficient to really counter a bank run or anything of that type. Presently, it would be the national governments, or if, of course, the problems spread to all European countries, it would be all governments. Mm-hmm. But there's a lack of regulation and decision on this issue.
Finally, if you look ahead the next 12 months, what is your biggest hope and what is your biggest fear?
Well, the biggest hope is that the structural reforms that have been enacted, that they will show some impact on the economies, especially on labor markets. A little bit like what we experienced in Germany after the reforms from 2002 to 2005, with declining unemployment, rising unemployment in the years right after the reforms were ended. That's my biggest hope, that this will take place also in Europe. The reforms have not been as miniature as many people say. What countries like Spain, for example, have done on the labor markets is quite impressive. Mm-hmm. Or what countries like Italy have done in terms of pension reform is quite impressive. Of course, it could always be more and faster and quicker, but there is a political reality that such reforms take time and hit opposition. So my hope would be that these reforms that have been taken will show impact and that they will be continued. And that leads to the biggest fear, that unemployment, especially youth unemployment, will finally create a very vicious climate against any further reform. This cannot be ruled out, and I think it's a risk that calls for more and quicker action to actually curb the problem of youth unemployment. This addresses the nations themselves, where the real problems lie, but also the EU, which could rechannel some of the funds it has in order to alleviate a little bit this problem of youth unemployment, because this is getting very, very critical. Personally, I think this is a risk. I do not think that the unemployment situation will completely derail the process of reform. Mm-hmm. But you asked what is the biggest risk, and that I say would be the one.
Michael Heise, thank you very much.
Thank you.